It's not like if you buy 3 shares of Lordstown stock, CEO Steve Burns is going to get on a Twitch webcam and write your name on his tits with a Sharpie. Come on, you guys don't need to white knight a company. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of June 14th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Last week was a really exciting week in the markets. News-wise, not so much, but there were a lot of big stock moves in stocks that I am very interested in, up and down. So either way, it was quite the entertaining week. If you take a look at the top 4 indices overall on the week, the S&P 500, NASDAQ, and Russell 2000 all ended much higher than they started the week. The only index that ended on a sour note would be the Dow Jones Industrial Average, but, you know, just a bad week for those boomer stocks. A couple weeks ago, that was the only index that was positive, so I guess it all just evens out. I did release a second video this weekend. It's not a full DD, but on Saturday, I released an explanatory video about the Pershing Square Taunton Holdings deal with Universal. The deal was very complicated as far as SPAC deals go, but I went ahead and explained it in the best way that I knew how. So if you guys haven't checked that out, please do so. I am quite happy with the outcome of that video, and I hope you guys do enjoy it as well. Let's get started with the news. Just a reminder, if you are new to my channel, I do publish all of my technical analysis every single week. This is my practice that I'm sharing with you guys. Again, the link is below the video, so go ahead and check that out if you're interested. First news story, Amazon will overtake Walmart as the largest US retailer in 2022, JP Morgan predicts. JP Morgan analysts have a bit of a history of making very bold predictions on companies that the firm has a long position in. I can only assume that they're long on Amazon. I didn't check that, but seeing as Amazon is one of the largest stocks in the US market, it's pretty logical to go ahead and assume that. Amazon's retail business is the fastest growing at scale, and the coronavirus pandemic accelerated Amazon's growth, whereas it hurt many other businesses. Stuck-at-home consumers turned to Amazon for a plethora of goods ranging from toilet paper to workout gear. They also relied on Amazon for services they might not have otherwise considered, such as online grocery delivery. Amazon's pandemic-fueled sales surge has helped it grow its slice of the e-commerce market. JP Morgan estimates Amazon expanded its share of the US e-commerce market to 39% in 2020, up from 24% in 2014. So the analyst is estimating that as far as the market share goes, Amazon increased to almost 40% from a quarter to 2/5 in just 6 years. When you look at a company's percent share of an addressable market growing that quickly, from 24 to 39%, plus 14% in just 6 years, that is stupendous. Not because it's growing in a vacuum, but rather it's growing and out-competing other people in the space. That's why looking at a company's percent share of an addressable market is always a stronger indicator of where they stand as a company, as a competitor. And Amazon is clearly winning that battle. Another Amazon-related story with Blue Origin. Blue Origin is to Amazon and Jeff Bezos what SpaceX is to Elon Musk and Tesla. Blue Origin auctions off a seat on the first spaceflight with Jeff Bezos for $28 million. The winning bidder will fly to the edge of space with the Amazon founder and his brother Mark on Blue Origin's New Shepard rocket. This is the rocket here, and I have never seen this rocket before. That looks absolutely remarkably phallic. Wow, that's impressive. Bidding for this auction opened at $4.8 million, but surpassed $20 million within the first few minutes of auction. The auction's proceeds will be donated to Blue Origin's education-focused nonprofit Club for the Future, which supports kids interested in future STEM careers. So the money's going for a good purpose. So for $28 million, this yet-to-be-named person is going to be flying into space with Jeff Bezos, his brother, and the crew of the phallic-shaped rocket. This is the interior of Blue Origin's New Shepard capsule, and you can see right in the middle of the capsule, they have a gigantic Alexa, play Despacito. Also in this article, there's a mention of Richard Branson and the VSS Unity right here. I tweeted about this earlier this week when I heard Bezos was going up on July 20th, specifically because as Richard Branson of Virgin Galactic has said multiple times he plans on going up into suborbit on his birthday, July 18th. So the middle of July might be a very interesting time where we have two of the wealthiest people on the planet leaving the planet. If Branson does indeed beat Bezos into space, I can only imagine what that's going to do to shares of Virgin Galactic. This billionaire competition into space could well be the best thing to happen to that stock. GameStop released its earnings this week, and it also appointed a new CEO and CFO, technology veterans Matt Furlong and Mike Recupero. Net sales increased 25.1% to $1.277 billion compared to $1.021 billion in the fiscal 2020 first quarter, overcoming a nearly 12% reduction in the company's global store base due to strategic de-densification efforts and continued store closures across Europe due to COVID-19. Operating loss was an improvement of $40.8 million compared to $108 million in fiscal 2020, and the net loss of $1.01 per diluted share compared to $2.57 per diluted share in fiscal 2020 first quarter. I think the most impressive thing in the entire earnings report is right here, though. As of May 1st, 2021, the company had $770.8 million in cash and restricted cash compared to $583.9 million in cash and restricted cash the prior year, but the company had no borrowings under its asset-based revolving credit facility and no long-term debt. Perhaps overlooked in this excitement of GameStop's meteoric rise in share price is the fact that the company has issued some shares and completely paid off their debt. They are debt-free. Just think about it. Not even a year ago, companies were shorting GameStop, hoping that they would go bankrupt, and here we are today with a huge market cap, a new, younger CEO, a new, younger chairman of the board, both qualified individuals, and the company is completely debt-free after having executed a de-densification of its stores, where it closed down all of its unnecessary stores and got rid of a lot of its unnecessary expenditures. Whether or not you want to buy into GameStop and whether or not you care about the entire short squeeze phenomenon surrounding the stock, you cannot deny that this company is taking advantage of the current situation and setting itself up for an absolutely luminous future. If we take a look at the chart for GameStop, it was not very kind after the earnings report. We did get as high as $344 this week on Tuesday before declining a bit on Wednesday and then falling all the way down to $211 at the low point on Thursday. And then we recovered a little bit, already back up to $237. GameStop's wild ride continues. Had a really interesting situation this week on Tuesday. FSLY, which is a $6.5 billion market cap company that helps websites like Amazon and Reddit load pages quickly, went down on Tuesday. Even though FSLY went down and brought websites like Amazon and Reddit down with it, the share price rose 11% on Tuesday. Instead of punishing the web services group for its mistake, investors appeared to reward it for inadvertently demonstrating its importance. Now, this is obviously just an opinion piece that I'm pulling from, but the headline is pretty hilarious. FSLY, failing upward cannot be a long-term strategy. There were a lot of hilarious memes and articles posted this week on FSLY saying that this entire outage was actually engineered by their PR department because nobody knew what their company did or how important they were. It's of course tongue-in-cheek and not true, but still, the fact the company was rewarded for failing to do the one thing that they are paid by their clients to do, awesome. With FSLY, here's their chart. On the 7th, you could see they were closing at 50.70, and then on Tuesday they had the outage. They opened at 49.91, ended up closing the day at $56.20 after hitting a high of almost 57. Those gains continued on into Wednesday before pulling back at the end of the week, but they still did close on a net positive on a week where they probably had one of their worst tech outages in the company's history. I was just thinking, what if my job was like FSLY and I just didn't submit a project to a client on time? I don't think anybody would reward me for that failure to do my job, but it's really great that FSLY was rewarded for failing. It kind of reminds me of everybody getting a participation trophy just for trying. You went out there and did your best, son. Here you go. This is kind of a weird one. The FDA announces approval of Biogen's treatment for Alzheimer's disease. Today, the FDA approved Aduhelm to treat patients with Alzheimer's disease using the accelerated approval pathway under which the FDA approves a drug for serious or life-threatening diseases that may provide meaningful therapeutic benefits over existing treatments when the drug is shown to have an effect on a surrogate endpoint that is reasonably likely to predict a clinical benefit to patients, and there remains some uncertainty about the drug's clinical benefit. This last part, there remains some uncertainty about the drug's clinical benefit. This is why this is interesting. I don't really care that the drug was approved, but this is very controversial. It's almost like the FDA went against their own rules here, because for the accelerated approval pathway, there has to be indication that the drug is going to provide meaningful therapeutic benefit over existing treatments, and in the case of Aduhelm, that is absolutely untrue. This did not sit well with the FDA's expert panel. Keep in mind, the FDA makes the final decision on drug approvals, but they also have expert panels that they pay to help them review research, keep everything non-biased, and make sure there's active researchers with different perspectives looking at all of these findings and studies. The problem with Aduhelm is that the FDA's expert panel that they asked to review the data did not suggest it for approval, and it ended up leading to 3 resignations. A third member of a prestigious FDA panel has resigned over the approval of a controversial new Alzheimer's drug. The committee voted against approving the treatment. Now, the FDA is not required to follow the panel's recommendation, but they usually do. Aduhelm failed one of its late-stage clinical trials and didn't produce conclusive results in another trial. So there were a couple of trials here. The drug failed one, didn't produce meaningfully conclusive results in the other one, and still the FDA is like, green light, stamp it, approve it, send it off. Some of the comments from these medical professionals resigning from the panel are absolutely scathing. Dr. Aaron Kesselheim, professor of medicine at Harvard, the approval was probably the worst drug approval decision in recent US history. And he said the entire FDA as an agency is not presently capable of adequately integrating the committee's scientific recommendations into its approval decisions. Oh shit, academic burn! This will undermine the care of the patients, public trust in the FDA, the pursuit of useful therapeutic innovation, and affordability of the healthcare system. That last part might be a little bit of a stretch because healthcare in America is already not affordable, but okay. Dr. David Notman, one of the other doctors who resigned from the committee, said the advisory committee had been mistreated by the FDA's decision. That seems illogical, and I don't want to be part of that in the future. So what did this mean for the Biogen stock price? Absolutely nothing. When the news was announced, the day that it was announced, the share price opened at $295 a share. On that same day, it went up to $468.55. This stock ended up going up over 50% in a single day at the high point, although it did just close at a 38% gain. Only 38%, guys. Oh, it's underperforming so hard. Even with all of the news of these people resigning from the committee and protesting the decision, it ended up climbing each day after the close of the initial hype, and we're still $100 higher than where we started the week. Honestly, I feel like there's going to be a lot of pressure on the FDA to reverse this decision. I don't really know if they are, and I'm obviously not going to be shorting this stock because the IV right now is way too high. So even the shorts, I looked into them, they're incredibly expensive. So I wouldn't touch this with a 10-foot pole, but I will absolutely sit here, sip my wine, and watch it fail. Speaking of failure, Lordstown Motors said it doesn't have cash to start commercial production. I think a company needs cash to build expensive things like cars. Electric truck startup Lordstown Motors disclosed it doesn't have sufficient cash to start full commercial production and has doubts about whether it can continue as a going concern through the end of the year. A spokesman for Lordstown Motors said the company isn't moving back its September target for the start of production and hopes to raise more capital, potentially through asset-backed financing or a government loan program. He declined to comment on why a going concern warning wasn't included in the company's original annual report filed in March. I don't really need to cover more about this. We've already been talking about Lordstown Motors on this channel. We've talked about the short report. We covered that. We covered the absolutely bogus interview with the CEO where he was wearing a hard hat and standing in front of a factory trying to look like he was hard at work. And when he was asked about all of the pre-order fabrication numbers, he said, "Oh, nobody actually thought those numbers were real." This company just keeps stumbling over its own feet. They didn't report this going concern in their annual report report back in March, and that's kind of something that you're supposed to clearly communicate with your investors in the interest of transparency, and this could well result in huge lawsuits. Like, we're talking company-ending lawsuits for failing to report a going concern. Also this week, Lordstown Motors missed a deadline on filing a 10Q. After the short report, you would think this company would be like on top of their game, A-game stuff right now. No more mistakes, guys. We gotta make it happen. It's almost like they don't even care. Every time I talk about Lordstown Motors on this channel, I get people in my comments section like defending the company, and I understand that people are passionate about their investments, but you can't fall in love with an investment. An investment is just a tool for you to increase your own net worth. It's not like this is your wife or your husband and you need to defend their honor. People who come into my comments section talking about Lordstown Motors, I mean, they're effectively white knighting the company. It's not like if you buy 3 shares of Lordstown stock, CEO Steve Burns is going to get on a Twitch webcam and write your name on his tits with a Sharpie. Come on, you guys don't need to white knight a company. I'm a huge Citius Pharmaceuticals bull, but if I found out Leonard Mazur was fabricating Minolock data and lying about it because he didn't think anybody thought it was real, I would drop Citius Pharmaceuticals from my portfolio faster than I empty my bowels after Taco Tuesday. Remember, guys, don't marry your investments. It's okay to walk away. If we take a look at the chart for Lordstown Motors, you can see exactly when this report came out. On Tuesday, we had a high in the day of 1580. We ended up dropping the next day to an open of 1012, and since then we've been floating between there and about 1150. Not a lot of good news here for Lordstown Motors because the company lacks the cash they need to make the trucks to sell to make the company grow in the future. This is bad. Next up, Wall Street Journal. This is kind of an interesting one. I've been talking about steel a lot on this channel, so I know you guys already know the basics. Steelmakers keep old plants idle despite surging prices. Companies cite the high cost of restarting the mills as closures add to the shortage of metal needed for cars and appliances. The closures have exacerbated a shortage of steel that is contributing to higher prices for cars, appliances, and machinery. United States Steel Corp and Cleveland-Cliffs are keeping about 7 million tons of production capacity out of service. That's roughly a tenth of the domestic consumption in 2019, according to Metal Strategies, an industry consulting firm. The reason that this is kind of interesting is because steel prices are so high right now. What is one way to alleviate high prices? To increase the supply. Cleveland-Cliffs and US Steel are facing some backlash from the public, from customers, because they have old mills right now that are shuttered and they're not operating them. If they were to operate them, the idea here is that they could help bump down the prices of steel in the country. And there's people that are saying the companies are being selfish about this, and they're only thinking about their own profits, and they're not thinking about what's best for the economy in the country. I'm sorry, is America not a capitalist nation? That sounds strikingly like a socialist proposition. What on earth would incentivize Cleveland-Cliffs and US Steel to open up old plants that they said cost more to maintain and to staff and to run because they're inefficient, and they would actually cut into the company's profits and start accumulating losses for the company if they were running? What incentive does the company have to do something like that? Honestly, you can't pressure a company into doing that. The only way these companies could possibly or should possibly open up these plants is if the government comes in and subsidizes the cost of opening the plants and then pays the companies for their lost revenues as the steel prices inevitably come down with the additional production. But still, that's government overstepping its role, and I am incredibly laissez-faire here, and I do not agree with the pressure on these companies in this situation. Bravo to US Steel and Cleveland-Cliffs for standing up and not opening these plants. Take a look at the Cleveland-Cliffs chart. You know, this isn't really tied in with the news of the steel price, but Cleveland-Cliffs did have quite the rise this week. It kind of got caught up in a little bit of the hype with Reddit, with Wall Street bets. I wasn't complaining, but it was really nice to see Cleveland-Cliffs rise. I did close out my options on Cleveland-Cliffs that I had open. I took my profits on them, but right now in the option chain, the prices are really high because the stock price had such a really big move this week. So the IV is higher, the options prices are higher, and I'm just gonna wait for it to settle down before I re-enter a position on Cliffs. The CPI report was released this week for May 2021, and shocker, we had more inflation. Thankfully, the increase was smaller smaller than that in April, but we are still up overall. Over the last 12 months, the all items index increased 5% before the seasonal adjustment. This was the largest 12-month increase since a 5.4% increase for the period ending August 2008. Right here, the second paragraph, and this is the only reason that I checked this entire report. The index for used cars and trucks continued to rise sharply, increasing 7.3% in May. If we come down to the table and we look at the seasonally adjusted changes from the preceding month, look at used cars and trucks coming across November to present. We've got -1.4, -0.9, -0.9, -0.9, 0.5, 10, 7.3. You guys know I am a huge Shift bull. Shift sells used cars. The last earnings report we saw from Shift had them absolutely killing it with their income, with their revenue, with their EPS. That was when the inflation for used cars was at -0.9, -0.9, and 0.5. So for 2 of the months on that quarter, the cars were actually losing value relative to currency. And the next earning report is going to have this 10%, this 7.3% figure on it, and whatever we get here in June, which I'm sure it's also going to be really high like these numbers. We've got an earnings report coming up in a couple months for Shift, and I don't see how this earnings report is not going to be the greatest earnings report of the company's history, and perhaps the greatest earnings report of the company's history and future for years to come because of these inflation figures. And you might ask, well, if used cars are raising in value, isn't Shift paying more to acquire them? Yes, they are, but they can still increase their GPU, their gross profit per unit, by marking up the price even more for consumers, because consumers just see on the news, oh, used car prices are going up, whatever. So Shift can take advantage of the environment. Even though they're paying more for the units that they're bringing in, they can charge even more for the units that they're sending out and increase their GPU. For used car sellers like Shift, like Lots, like CarMax, like Carvana, their GPU, their gross profit per unit, is the big metric to see how they are succeeding or failing as a company. Last week, I talked about Greif GEF. It is a company that makes shipping containers. I talked about the earnings report being stellar because the company had increased their guidance and shipping costs are rising around the globe. People are paying more to bring commodities because of rising commodity prices. As expected, the earning report was phenomenal. The company's revenues of $1.34 billion surpassed the street's estimates of $1.26 billion and jumped 15.7% from the year ago period. Earnings came in at $1.13 per share, beating the consensus estimates of $1.06 and an increase of 18.9% year over year. And with improved visibility into customer demand patterns, we're reintroducing annual guidance for fiscal 2021. We're well positioned to benefit from a growing global economy. Let's take a look at Greif's chart. You could see on Monday right here when I opened up my options position, the low on Monday was $59.35. I'm pretty sure I bought my calls right around that $60 level. And here we go. By Friday, we ended up hitting a high of $64.82. Really great gains. I mean, this is, a $5 gain for the week on a company that typically trades low volume and doesn't experience big moves. Really happy with this one. I closed out my calls for Greif right around a 20% gain. And I had other people tweeting at me. They hit like 42, 43%. Somebody even tweeted they got a 58% gain. So they must have gotten really lucky with a fill for a low ball order, but happy for everybody. This was a fun one. I got a little nervous though on Thursday because the volume was so low after the earnings report and we didn't really experience that gain until Friday. It's almost like the company was so small, nobody really knew about them and knew to look at the earnings report. So it took a while for that to catch on and we didn't really get anything as far as price movement goes until Friday. There was a brief period where on Thursday after earnings, I was like, oh, well, I guess I just have to sit on this one for a couple of months because I bought the October calls, but I was able to close it out on Friday, less than 5 full trading days after opening it. So I'm pretty happy. Let's take a look at the upcoming earnings for this week. There is not a whole lot, and I am just not excited about this week. We have Hexo coming in before open. They're a pot stock supply company. If you look at their financials, they're pretty crap. I mean, this company spends a lot of money to make its revenue and its net income is really low. Motor Parts of America is an interesting one. I'm not going to do anything this week, but they sell parts for used cars. And with the increased number of used cars being purchased, I can imagine Motor Parts of America is going to be a strong play, maybe in about 6 months to a year, as all of these used cars are going to start needing maintenance, needing new parts coming in. So this is one that I'm kind of filing in the back of my little brain drawer to keep in in mind for the future. Mama Mancini's, they make meatballs and other frozen Italian foods. It's basically a penny stock, but they've had increasing revenues for like 8 straight quarters or something ridiculous. Don't quote me on that. I looked at their financials a while ago. This is one that I've been looking at, but not entering a position because I think my money's better spent elsewhere. Volt, I want to look at more closely. Lennar. You guys know I've been playing home builders, playing materials, talking about that type of boom, the boom in home building, but I started seeing some really weird news coming out that home start numbers were declining. Some analysts degraded their projections for prices on some home builders. Lumber prices have gone down, but they were really high for a long time, and I'm starting to wonder if the home starts slacked off because people were waiting for the lumber prices to go down. I mean, it's not just people, it's companies. Remember Sanderson Farms a couple weeks ago? I talked about how they were not opening a warehouse because the lumber prices were too high. Lumber prices affect everybody, and they will deter people from building. With Lennar, I don't really know what to expect. On the last earnings report, I was incredibly bullish, and I was very confident. This time, I really think they're going to report a number that is good, but it's probably already baked into the share price, and I think they're going to report a decrease in their backlog for home starts. And people are going to look at that a little bit unfavorably, and the stock price might take a little hit here, but I'm not confident enough to buy puts on that. I'm not confident enough to buy calls. I don't really want to play a straddle. I just want to kind of ignore this one and watch it from the sidelines. We also have CMC reporting on Thursday. Now, I could talk about CMC because I have been talking about steel, but if I was going to spend any money on steel, I would rather just buy shares of Cliff or buy leaps on Cliff. I just don't really want to play CMC right now. I was looking at the options. It seems like the IV is really high, and I think people have kind of caught on to steel for an opportunity right now. It's no longer a secret, and I don't think the huge gains are there to be had. I'm not saying you can't make money on CMC this week, but I am saying you're going to make less money because the options are going to be more expensive. So to me, the risk reward isn't there for playing an option on CMC around their earnings. I'm sure it'll be a good earnings report, but I'm not going to do anything with it. Let's take a closer look at Volt. They deal with staffing, workplace staffing. This is a penny stock that you can trade options on. Oh boy, I'm excited. We covered this on my channel a couple of weeks ago, how there's actually a labor shortage in America right now, which is a little counterintuitive because we talk about the jobs report every week. We talk about how many people are still jobless, but even though these people are jobless, they would rather take the government unemployment benefits than go back to work because the unemployment benefits are paying them more than the minimum wage would at the jobs that they could work. Oh, how confusing. Walmart, the second largest private sector employer, announced raises for 425,000 employees in February, lifting its average wage above $15 an hour. The second largest private employer in the US, Amazon, said in April that more than 500,000 of its employees would see pay increases of between 50 cents and $3 an hour. Costco Wholesale Corp lifted its starting wage to $16 an hour earlier this year. Do you think all of these huge employers are raising wages for their employees because they want to? No. Companies are not benevolent. We talked about that just minutes ago with Cleveland Cliffs and US Steel. Companies look out for their own interests. These companies are raising wages for their workers because they have to. They're raising wages because people don't want to work for the lower wages, and the companies need to incentivize people to come to work so their companies can continue to function. The US labor shortage is a national economic emergency getting worse by the day, the Chamber of Commerce said. In some states, there are more job vacancies than available workers. I'm not good with math, but that sounds not ideal. The US Chamber of Commerce called the labor shortage an emergency. They described the shortage as hitting multiple industries as a threat to economic recovery. There are more job vacancies than available workers in South Dakota, Nebraska, and Vermont. Okay, those 3 states, that's probably not the greatest example for what we're talking about here, but let's continue anyway. The worker shortage is a national economic emergency and poses an imminent threat to our fragile recovery in America's great resurgence. Okay, great. We've established there is a worker shortage. This is being reported at the federal level, at the private level. We know that companies are having a hard time finding workers. So, who benefits from this situation? Staffing agencies. Staffing agencies that companies can contact to bring in temps and carpetbaggers to fill the employment needs that they need right now. This is the investor presentation for Volt. They focus on North American staffing. So we're talking about the US economy, the US labor market shortage. I suspect that the labor shortage right now is a US specific thing because of the way the government structured the coronavirus relief packages here for unemployment. The fact that the majority of this company's business is in North America and the US, this is good for my thesis for this options investment. Their March 16 first quarter financial results, their gross margin was 15%, a 60 basis point increase compared to the prior year quarter. Why would their gross margin be higher? Because companies are paying them more to find these workers for placement. I wanted to test my hypothesis for this company by looking at other staffing agencies that have already reported their earnings because we are pretty late in the quarter. The problem is I really don't know any staffing companies. This isn't an area that I'm too familiar with, so I looked it up. The 5 largest US staffing companies as of 2019, Allegus Group, which is not publicly traded to my knowledge, Randstad Holdings, which does most of their business in Europe. They have some stuff in America, but their numbers are going to be skewed because of the European income, so I'm going to ignore these top 2. Adecco, Robert Half International, and Kelly Services. These are all publicly traded in the States, do most of their business in the States, and I'm going to take a look at them. Start with Robert Half. They reported their first quarter financial results. We are extremely pleased with our first quarter results, exceeding the high end of our guidance and reflecting a broad-based recovery that is well underway. Beat guidance, CEOs talking about economic recovery. This is good. This fits with my thesis. Adecco, we're seeing an acceleration in the permanent recruitment in white-collar jobs. Blue collar has been a bit slower to pick up, but we expect to see an improvement in that business. The Biden stimulus is clearly helping the economy as a whole. There's no question the US economy is coming back strongly. We tend to benefit from the early stages of a recovery. Okay, more cool insight. Staffing agencies tend to benefit from the early stages of a recovery, which is, that's what we're in right now. This is good. This supports my thesis. Kelly Services, from their CEO, we're seeing strong demand across all of our operating segments. This translated into sustained sequential revenue improvements in education, OCG, international, science, engineering, technology, business sections. We're also seeing improving revenue growth rates in our professional industrial segment, and we're taking steps to capture even more of a stronger demand, which now exceeds pre-pandemic levels. Okay, Kelly's seeing sequential revenue increases and demand that is surpassing pre-pandemic levels. This, again, points to a recovery, and it supports my thesis that Volt is going to have an incredible earnings report. Let's take a quick look at the Volt chart to see if this is even a good buying opportunity. We're trading right around the 50-day moving average, but we're well below the high of 451 that was hit in early April, down here at 379. It looks like we have a pretty strong line of support here around the $3.50 level. On the chart, we've got about 4 or 5 visible contact points for this line. The 14-day RSI, which is the one that I like a little bit better, that's the blue one here, is right at 50, so it's in the middle and it's climbing. And we can see right here the MACD is in the middle of a reversal, so we're entering an uptrend. So we've got an increasing RSI, an uptrend. We've got a strong support that's about 30 cents below the current price, and we're below the recent high. Everything on the technicals right here says we're in good shape, and on top of that, the volume is starting to increase again heading into earnings. What about the options? Since it's a penny stock, there's obviously not many option strikes available. We've got June 18th. Obviously, I'm done playing FDs. I'm not going to even look at this one. July 16th, that's only a month away. That seems kind of close. I'm uncomfortable with it. August and November. I kind of am looking at this November here because the company trades at a really low volume. We're talking 100,000 shares with a free float of 14 million. This is incredibly low volume. This is actually even lower volume than the option we played last week. But look at the open interest on the options chain. Apparently, other people have the same idea as me. Right here, we've got 1,479 for the open interest on this $5 strike price on August. I don't really want to play that because it's so far out of the money. Because the volume is so low here, I would actually feel much better playing the $2.50 call, and I think I'm going to do it out here on November. If you look at the July $2.50 strike, it's selling for $165, and if you look at the one in November, it's selling for $155. So rolling out an additional 5 months actually saves you $10 per contract, and the open interest is high enough to where I should be able to get a fill. Not sure how many of these I'll buy. I'll figure that out Monday morning. morning when I see the actual price for the contract. As always, when I'm buying my options, I don't buy them right at market open. I try to wait 15 or 30 minutes for some of the weekend volatility to die down, but I don't want to wait too long because the earnings are reporting early in the week. So I want to try to sell before the earnings if I hit my 20 to 30%. If not, I will hold these because I think this is a macro trend that I'm pretty comfortable with banking on. So if I have to hold these ones through earnings, I'm not going to like cry and lose any sleep about it. Like I said, this is a macro trend and I think this will be okay. All right, everybody, that's it for me today. I hope you enjoyed the video. As always, if you're new to investing and you want to support the channel, check out my Webull referral link below the video. If you use that referral link to sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins, and I greatly appreciate it. If you enjoyed the video today, please make sure you like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you next time.